Hey everybody, I'm joined by one of my favorite Motley Fool contributors, Lou Whiteman. Lou, good morning to you, sir.
Good morning. Good to see you, Matt.
Good to see you. We're going to dive into small cap stocks and why they are finally starting to beat the S&P, whether it's going to continue and what investors need to know about it, why they've been underperforming for a long time. Before we dive in, take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that link is fool.com/Frankel. All right, so Lou, before we dive into it, let me just share my screen real quick. I wanted to put a chart up there. You can see this chart. So this is the difference between the Vanguard Russell 2000 ETF, which is generally considered the best small cap index, and the Vanguard Russell 2000 or the Vanguard S&P 500 ETF, which is the orange line. Vanguard, so small caps are the purple line, large caps are the orange line. So over the past month, you can see that the small caps have outperformed large caps handily. With you can see most of the outperformance is right here in the past 2 weeks or so. Now we'll talk about what happened there in just a minute, but I want to kind of zoom out a little bit. So over the past 1 year, even with that big increase, the small caps are losing to large caps pretty big. 7 percentage points of difference over 3 years. The gap gets even wider. 25% or 26% versus about 2%. Over the past 5 years, even wider, a gap of about 40 percentage points of outperformance for large caps. And over the past 10 years, it's even worse. It's been a terrible time to be a small cap investor, about 85 percentage points of outperformance for large caps. So, first of all, why have small caps outperformed lately? I think it has something to do with inflation.
Yeah. I think, and that's the interesting thing, because that gets right to the idea of, is this just a blip or is it permanent? I mean, I think some of it is just whether it's algo or just short money trade, thinking, all right, if the Fed is going to cut, interest rates disproportionately hurt small companies. If you are Alphabet, it's a lot easier to handle higher rates than it is if you are a $100 million revenue company. So therefore, small cap companies should react more positively to a cut in rates. So this is sort of the knee jerk with rates, but there also could be something going on here because look, as you say, things are not supposed to stay in that sort of trend for a decade plus. I mean, I don't want to be like Charlie Brown with the football, but it does feel like at some point you got to make that kick, right? There's going to be an opportunity here.
Yeah, so there's a few reasons that I think this has happened and could continue. Um, One, we'll quickly dispense with the elephant in the room. This is being called the Trump trade, right? A lot, generally speaking, the Republican policies towards smaller businesses and just the generally more business friendly policies are considered more friendly for small caps, for a lot of the same reasons you just mentioned. So that could have a lot to do with it. A lot of the political kind of leanings and expectations right now. There's also it's not just the S&P that's outperformed. If you take out the Magnificent Seven, it's actually a lot more even. A lot of those S&P 500 returns have been disproportionately led by companies like Nvidia, by Alphabet, by Microsoft, things like that. Um, a couple more reasons. There's a bunch of reasons here. Small caps tend to be more leveraged, which is another thing. Kind of goes off what you were saying that they benefit from lower rates more. They tend to rely more on borrowed money than a company like Alphabet or Google or whatever you want to call it now. And there's a lot of money on the sidelines right now. Um, People keep a lot of money in CDs now compared to just 2 years ago, or Treasury bonds that are paying 5% that were paying nothing a few years ago. And as that kind of money rotates back into the market, it favors more speculative stocks. And with interest rates expected to fall over the next couple of years, you can see kind of a cascade of money flowing in, and it won't all go into small cap stocks, but generally people aren't keeping money on the sidelines with the hope that they'll someday be able to buy the S&P 500 index fund. They keep
Right.
money on the sidelines hoping it's going to be a better environment for speculation and having fun, or more exciting investing, right?
Mm-hmm. Mm-hmm. So let me like just kind of looking at like is now an opportunity. And I want to play the devil's advocate first, because full disclosure, I mean, the way I treat my portfolio, I have the top half is just these stalwarts, but a lot of my portfolio are these small caps with me just speculating. So I do hope this continues, but there's an argument to be made that the justification for that 10 years of underperformance is that there is a lot of junk in small caps. Now more than ever, it is a lot easier. Venture capital has grown up. There's a lot more money in venture capital. Promising young companies, the next alphabets don't have to go public as early. So you don't have as many of these just potential all-stars sitting in the Russell 2000, or they're sitting, in the small caps. I think that's an argument for being selective in small caps, but there is this argument that is out there that there's good, solid reasons. And small caps just as a group are never coming back just because it is disproportionately more losers than winners than it was even 30 years ago when the world was different. The reason I sort of like small caps, though, is I do think that, yes, this is still your opportunity to get big winners, and that if you can be selective, there are still great companies in there. And I think, Matt, for the reasons you say, I think that the environment is turning for them. It is interesting, too, that the Magnificent Seven did terribly during that low sort of 5 sessions in July, where it's kind of to support your idea that the money was flowing from one to another,
Yeah, and you make a really good point about there's a lot of junk in the market now that wasn't the case maybe 10 years ago. Think of the SPAC boom that we saw
Yeah,
just a few years ago. Let's be honest, a lot of companies that you and I invested in probably shouldn't have gone public. Like
exactly.
they weren't
Definitely.
great businesses at the time. And a lot of that's still hanging out in the market. I still have some SPAC, you questionable SPAC calls in my portfolio. Um, but I'll leave you with this. The last time that small caps traded at this low of a price to book valuation relative to large cap counterparts was in 1999, so about 25 years ago. After that, small caps outperformed for the next 13 to 14 years. Now, there was a lot that happened in that time.
Yeah, I don't know if
Um,
we want all of that to
no,
repeat, right?
there was the .com bust, which disproportionately affected large caps because a lot of junk became large caps in that period of time. And then there was the financial crisis, of course, that adversely affected a lot of large caps. I mean, the S&P 500 drew down by more than 50%. Um, we don't want that to happen again. But it was a better environment for small caps than you're seeing today. There weren't the mega cap tech stocks. I mean, I think at the time of the end of the financial crisis, the biggest stock in the market was Exxon. It wasn't
Mhm.
a big tech stock. So it's going to be an interesting time. I'm like you. I have a lot of money in small caps. I'm very selective about what I buy, especially after the SPAC lessons I learned. I'm sure you and I can record a whole video on the lessons we learned in 2021 and 2022.
Oh yeah, we should do that, and then we should come back and we should pitch some to each other.
Yeah, that would actually be a fun video. We'll plan on
Yeah,
doing that.
yeah.
But so hopefully you enjoyed that. Leave us some comments. I'll do my best to respond to any of them individually, and we will see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.